Hello everyone. So now let us start with a new chapter, and that is your international financial management. So this chapter is relatively easy, and this chapter covers the concepts of investment decisions, that is your advanced capital budgeting decisions, and some part of your forex as well. So the prima facie objective of learning this particular chapter is that if you are making your investments outside your home country, okay, so if suppose you are making investments in any of the foreign countries, then how are you going to calculate and evaluate the particular project? What are going to be the different approaches on the basis of which you will be calculating the benefits which will be generated from the particular project, and then whether we should make the investments outside your country or not. Okay. So from the examination perspective, yes, sometimes institute can ask the questions on this particular chapter for approximately 8 marks. So I don't want you all to leave this as an option. And this chapter has around 10 questions, and where I will be first solving all the ICI study module practical problems first, and then we'll be looking for some illustrations and some of the uh, you know concepts and some advanced questions as well. So this chapter, if you have not practiced it earlier, then you all can practice this along with me, solve the questions along with me. Okay, wherever the questions are too lengthy, I'll tell you what should be the approach and how it should be solved, and we'll go through the solutions for the same. And initially, for the first 5 questions which are there in your study module, your practical problems will be solving it one by one fast. So you're definitely going to enjoy this particular chapter. So you can practice this right now, and then whatever important concepts which you feel like, you can just mark it and then revise one day before your examination. Okay. So let us quickly start with which all concepts are covered in your international financial management. So as I told you that, first of all, this chapter basically deals with this international financial management basically deals with your investment decisions which is going to be held outside your country. Okay. So basically, let's say for example, uh, you are in India, and let's say you want to invest in a project in India only. Okay. So in that particular case, what will be your approach for the purpose of evaluation of the project? You are going to take into consideration whatever is your present value of cash outflows. You will consider whatever is going to be the present value of cash inflows, and then ultimately you will be calculating the net present value, right? So what are the types of the cash outflows which you have? So you have something which is called as your initial investment, right, in a particular project. So that is nothing but whatever is the cost of the fixed assets, etc. And along with that, we also make some investments in your working capital. And what can be the streams of the cash inflows which can be generated? So then there can be the cash inflows from the projects which can be generated. Also, there can be some scrap or salvage value. And whatever working capital we invest, that is going to be recovered, right, towards the end. So recovery of working capital. Also, at the same time, the cash inflows that will be generated, if suppose, let's say, for example, they give you some information like this, that the project life is, let's say, for the period of 3 years. Okay. And from the fourth year onwards, the cash inflows are going to be constant till perpetuity. Then can we use the concept of terminal value to find out what is going to be the cash inflows at the end of the third year? Yes or no? Yes, sir. Okay. So basically, what happens is that sometimes they will give you that the cash inflows from fourth year onwards are going to grow at, let's say, for example, at a constant rate. Then we can apply your growth model for the purpose of determination of the terminal value, as the case was when we were discussing your business valuations and also your security valuation, right? So we can calculate the terminal value accordingly. So sometimes they will give you the cash inflows from the projects, right? And then they can give you whatever is the terminal value data. And with the help of all these cash inflows, what do? We quickly discount it and we convert that into present value terms. So basically, this was something what you all were doing in your investment decisions, right? And in this particular chapter, the only difference here will be that when we are investing outside India, okay, so definitely there will be cash inflows which will be generated outside India. So there will be cash inflows which will be generated, let's say for example, from US. So cash inflow generated in US will always be in dollars, right? So if I'm making investment outside India, that is in US, okay, so what will happen is whatever will be the cash inflow generated, that will be in dollars, and that dollars I'll be receiving at the end of first year, second year, third year. Also at the same time, I am going to make investments in US, so the investment will also be in dollars. So then one of the approaches is what, that you can simply calculate whatever is going to be your net present value in dollars itself, and then we can convert that into your rupees by applying spot rate, on the basis of which we can determine whether the net present value is positive or not. Similar to that, there is also a possibility where we can convert all the future cash inflows which is getting generated from outside India. We can convert that into your home currency, that is rupees in our example, and then we'll be getting the present value of cash inflows in rupees, which we can subtract from the present value of cash outflows, and we'll be getting the net present value in rupees itself. Okay, so basically there are different approaches on the basis of which you can evaluate the benefits which is getting generated from the project and then decide whether we should make investments or not. Okay, so the whole concept here is, in this entire chapter we are going to study that whether we should make foreign investments or not. Okay, so that's why, as I told you earlier also, this chapter is actually a combination of your advanced capital budgeting decisions and also at the same time whatever is going to be your forex. Okay, so why forex is because how to calculate your, foreign currency forward rates, how do we discount it, and how do we convert that into present value terms. So all these things, uh, you know the concepts will be applicable here for the purpose of determination of your forward rates for conversion from future value to present value terms. Okay, so first of all, my dear students, let us understand this entire concept, okay, uh, with the help of a particular example. Okay, see, let's say for example, there is a company ABC, okay, and ABC is placed in India. Okay, ABC is placed in India. Now ABC wants to invest in US. Okay, so definitely there will be some cash outflows today. Yes, sir. Let's say for example, $1 lakh. So we are investing $1 lakh today. Okay, at year 0. And at the end of year 1, year 2, and year 3, let's say for example, for 3 years, the series of cash inflows are, let's say, $50,000, $40,000, and let's say, 60,000. Okay, now these are your cash inflows which will be received in your foreign currency because investments are made outside India. Okay, so $50,000, $40,000, $60,000 will be received at the end of first year, second year, and third year. Okay, and we are making investments today for $1 lakh. Now I want to check the feasibility of this particular project. Okay, so now you will be wondering, sir, if you want to calculate the feasibility of the project, then first let us decide that whether we are going to use home currency approach or whether we will use foreign currency approach. Now basically, what do I mean by home currency approach? So under your home currency approach, what we do is that we convert all these cash flows in your home currency, and that is your rupees. Okay, so we will be converting from dollar to rupees. So that is something what we are going to do in your home currency approach. So what is our approach going to be? Convert everything from dollars to rupees. Okay, so let's say for example, your spot rate is $1 is equal to rupees 85. Okay, now definitely under your home currency approach, if you're converting everything into your home currency, that is rupees, so you will definitely need your forward rates at the end of year 1, year 2 and year 3. Okay. Why? Because there is some cash inflow which you are going to receive at the end of the first year. So we are receiving $50,000 at the end of the first year. So first of all, we have to convert that dollars into your rupees, right? So if you want to convert that dollars into rupees, what do you need? You need what should be the forward rate applicable at the end of the first year. Okay. At the same time, $40,000 is received at the end of the second year. So definitely you need a forward rate at the end of year 2 as well. $60,000 you are receiving at the end of the third year. So we also need the forward rate at the end of the third year as well. So basically we need a rupee dollar quote at the end of first year, second year and third year. Now how do you calculate that? So in Forex, you'll have learned something which is called as your interest rate parity and your purchasing power parity, right? So basically in your interest rate parity, so interest rate parity theorem, can that be used to calculate the forward rates? Come on, yes or no? Yes, sir. Okay. So basically in your rupee dollar quote, we know that dollar is your base currency, rupee is your counter currency. So if you want to calculate a forward rate, we can take spot into 1 plus whatever is your interest rate of your counter currency and we divide that by 1 plus whatever is your interest rate of your base currency. Can this be helpful to calculate your forward rate? Come on, yes or no? Yes. And in purchasing power parity, what happens is that we will be taking into consideration whatever is the inflation rate which is applicable for both the countries, and that will help you to eventually calculate what should be the forward rate. Okay. So basically, these are your cash inflows at the end of first year, second year, and third year. So we need to calculate what should be the forward rate, what should be the exchange rate at the end of year 1, year 2 and year 3. So once we get the exchange rate, can I say this will be helpful for you to calculate what should be your rupee cash inflow? Come on, yes or no? Yes, sir. And once we get the rupee cash inflow, what is the next thing you have to do? You have to discount it. And we will discount it at whatever is the cost of capital in India. Okay. Because we are using home currency approach. So in your home currency approach, what are you going to do? We will be converting all the future cash inflows from foreign currency to home currency. And that is something which will be discounting it at your discounting factor of your home currency. And based on that, we'll be getting your present value of cash inflows. Okay. So does the process look very simple now? Okay. Of course, we'll be writing down some important parts of the same, but first try to understand the concept because I don't want you to learn anything here. Just understand the concept that what are we going to do? Under our home currency approach, we are going to first convert everything into your home currency, that is rupee cash inflow. Then we'll be discounting it and then we'll be getting it into the present value terms. Okay. So first of all, do we have the spot rate available? Come on, yes or no? Yes, sir. That is $1 is equal to rupees 85. Now, once we have the spot rate available, that is $1 is equal to rupees 85. What we actually need is either interest rates or the inflation rates to calculate the forwards. So let's say, for example, the interest rates are given to you as in India, the interest rate is, let's say, for example, in India, it is 10%, and in US, let's say, for example, it's 5%. Okay. So how will we calculate the forward rates? So we can definitely apply this formula and calculate the forward rate accordingly. Okay. Or else simply if you want to do it like this, then can I say your 1 year forward rate will now become what? This will now become $1.05. Okay. And this will now become 85 plus 10%. So that will be nothing but rupees 93.5. Okay. So for $1.05 is 93.5. So for $1, this should be 93.5 divided by 1.05. So this will now become rupees 89.05. So I'm just taking up to 2 decimals. So this is nothing but your 1 year forward. Come on, yes or no? Yes, sir. So this will be applicable year. So your exchange rate is going to be $1 is equal to rupees 89.05. Now, similarly for year 2, okay, for your year 2 forward rate, what will you do? You will again add the inflation or the interest rates for both the countries, okay. So now this will give you $1.05, which will eventually give you 89.05 plus your 10%. So that is nothing but rupees 97.95, which can be now for $1 divide by 1.05. So that will give you 93.29. So this will be now your forward rate for the second year. Okay, so this is now going to be 93.29. So I'll write down here rupees 93.29. Similarly, now for year 3, okay, we have the forward rates as will be adding your 5% and 10% here. So which will eventually give you $1.05, which will be 93.29, add 10% to it. So this will now become rupees 102.62. So $1 will now become your rupees 97.73. So this is now going to be your year 3 forward rate, 97.73. So now I have the exchange rates available and I have all the foreign currency. So I can definitely calculate what should be your rupee cash inflow. Okay. So $50,000 into 89.05. So that will give you 44,52,500. Okay. Then similarly, $40,000 I need to multiply it by 93.29. So that will give you 37,31,600, and 60,000 into 97.73. That will give you 58,63,800. Now all this is your rupee cash inflow. So is this converted first from foreign currency to home currency? Yes. Now we need a discounting factor. So now you must be wondering, sir, what should be the discounting factor? So let's say, for example, your discounting factor in India under home currency approach is, let's say, 15%. So I'll be discounting now everything at 15% rate. So 1 divided by 1.15, and I will quickly discount this. Okay, so this will give you 38,71,739. Then I hope you guys are solving this with me. For your second year, this will now give you 28,21,626. And this will be 38,55,544, which will eventually give you 1,05,48,909. Okay. So is this going to be my present value of the cash inflows? Yes or no? Yes, sir. 1,05,48,909. Now, what is going to be your present value of the cash outflow? So your spot rate is 85. So I will now simply convert, because year 0 means making the investment today. So today, if you are making investments of $1 lakh and the rate is 85, so based on that, we'll be getting the present value of the cash outflows, which will be 85 lakh rupees. So I'll be subtracting that. And then eventually from this, if I subtract 85 lakhs, I will be getting 20 lakh 48,909. Okay. So is my NPV into positive? Come on, yes or no? Yes, sir. So should I make investments? Yes or no? Of course, yes. So under home currency approach, the concepts which will be applicable here will be: point number 1, you have to convert your present value of cash outflows from dollar to rupees. Okay. From dollar to rupees at spot rate, right? Second will be, we have to calculate the forward rates, right? And this forward rates can be calculated using your interest rate parity or your purchasing power parity. Then third is convert dollars to rupees with the help of forward rates, right? And then your fourth part will be, we will be discounting rupees in present value terms with the help of discounting factor, that is nothing but cost of capital in India. Okay. So ultimately, we'll be getting the PV of CI, from which I will be subtracting PV of CO. So ultimately, I'll be getting the NPV. So these are the things which you have to remember whenever we are dealing with which approach. Then it's your home currency approach. Okay. In your home currency approach. So I hope you all have understood this very easily. How do we do the calculations? Of course, there will be certain modifications here and there. There can be investment in working capital, which will be recovered towards the end. Also, at the same time, there can be some terminal value at the end of the project life. So all these things, we have to consider that in your decision making. Now, what happens in case of the foreign currency approach then? So in your foreign currency approach, what we'll be simply doing is we'll be calculating the net present value. Okay. First of all, in dollars only. Okay. So NPV will be calculated in dollars, and this NPV, we will be multiplying it by the spot rate to actually get what should be your NPV in rupees. Okay. So basically what we'll be doing here is we already have the PV of cash outflow as $1 lakh. Okay. Now, what will be your PV of cash inflows? So here we'll be taking into consideration year 1, 2, and 3. And then we'll be having the cash inflows as $50, 40, and 60,000. So we'll be having $50,000, 40,000, and 60,000. Okay. And now, my dear students, we have to discount these dollars, okay, at a particular rate to get the present value. Now here, I just want you all to focus properly, because students make maximum mistakes here. Okay, so now this is going to be your accident prone area. So here you have to be very careful. See, whenever we are discounting foreign currencies into your present value, then we should take into consideration what is the discounting factor outside India. Okay, so what is the discounting factor in US? We have to take that cost of capital, we have to take that discounting factor for the purpose of calculation of the present value. So this is the most important point you have to remember. So in the first case, we were using the discounting factor which was there in India. So that was 15%. Now in the second case, we will be taking into consideration your discounting factor, but that is the discounting factor which is applicable in US. Okay. Why? Because first of all, your discounting factor in India was 15%. Okay. Which was after taking into consideration whatever was your interest rate applicable in India. So your interest rate applicable in India was how much? It was nothing but 10%, right? So guys, I hope you all are aware about the concept that whenever there is a higher inflation or whenever there is a higher interest rate, then that risk premium is actually added to your risk-free rate, and based on that, your discounting factor is generated. So in the countries where the inflation rates are higher, where the interest rates are higher, in those countries, the cost of capital or the minimum required rate of return is definitely going to be higher, right? So that is why in India, the discounting factor is 15%, which is actually based on the concept of some kind of inflation or interest rate, which is the base 10%. But whenever we are talking about US and we want to discount the dollars into present value terms, so we need the discounting factor in US, and that cannot be 15%. Okay. So we have to neutralize that 15% and calculate what should be the cost of capital in US. Okay, so this is something which you'll have to understand. So first of all, this 15% is the discounting factor or minimum required rate of return or the risk premium or the discounting factor which is there in India due to the inflation rate of 10%. Okay. So basically, when the interest rate or inflation rate is 10%, okay, we are taking into consideration cost of capital of 15%. So when the interest rate in US, if it's 5%, then what should be the discounting factor? Now, this is something which we need to calculate it. So how are we going to calculate this? So basically, we can understand like this, that this interest rate of 10% is 1 plus 10%, that is 1 plus 0.1. So that is nothing but 1.1. Okay. So your 1 rupee becomes 1.1. Okay. At the end of year 1. And here when the interest rate is 5%, so this will now become 1 plus 0.05. So that is nothing but 1.05. Okay. And when this discounting factor or cost of capital is 15%, so that is nothing but 1.1.15. So what should be your discounting factor here? So if you cross multiply this, so we just have to take the base of 1. And on that, if we add 10% rate, so it becomes what? 1.1. For US, if we add 5% rate, it becomes 1.05. But if your cost of capital is 15%, so 1 plus discounting factor. So if it is 1.15, so for US, it should be how much? Okay. So if you just cross multiply this, it will become 1.15 divided by 1.1 into 1.05. So this will now give you 1.15 into 1.05, divide that by 1.1. So that will give you 1.097. Okay. So this is the rate which is coming. $1.097. So I will take this as 1.0977. So it's nothing but 9.77%. Okay. So 1.0977 can be represented as your 9.77%. So basically this is nothing but 1 plus discounting factor. Okay. So if your discounting factor is 9.77%, so we write down like this, right? 1.0977. So ultimately this will become what? 1.0977. So basically your discounting factor is nothing but 9.77%. So you just eliminate the base 1 from it. So you'll be getting 9.77%. That is your discounting factor. And of course, the discounting factor in US is going to be lower than the discounting factor in India. Why? Because there the interest rates or there the inflation rates are relatively lower, right? So based on that, we will be getting what should be your discounting factor in US, and that is nothing but 9.77%. Okay. So basically, I will now have to discount all these cash flows at 9.77% to ultimately get what is the present value of the cash inflow, and that is going to be in dollars. Okay. So what is the present value of cash inflows in dollars? Now that is something which we have to calculate it. So how will you do that? So 1 divided by 1.0977, and you need to multiply that by 50,000. So this will eventually give you 45,550. Then you will take 1 divided by 1.0977 and multiply that by 40,000. So I want you all to do the calculations with me only. So 36,440. So at the time of revision, I hope that entire hassles are then taken care of because you've already practiced all the questions once. Okay. 1 divided by 1.0977, which we need to multiply it by 60,000. So this will now give you 45,363. So eventually this will now be $1,27,352. Okay. So I've already calculated in dollars the present value, which is coming as 1,27,352. Now, what was my present value of cash outflows? It was $1 lakh. So ultimately, I got the NPV in dollars, which is 27,352. But guys, do we have the spot rate available? Of course, yes, we have the spot rate, and which was nothing but 85. So if I now multiply this by 85, I'll be getting 23 lakhs 24,959. Okay. And in this particular case, it was coming as 20 lakh 48,909. Your NPV should actually be the same only whether you use your home currency approach or whether you use your foreign currency approach. Okay. So in both the scenarios, it has to be the same. So there is one calculation mistake here, and this is actually coming as 33,197. So ultimately, the final answer here is going to be 1,24,109, from which if I'll subtract 1 lakh, we'll be getting here 24,109. And this if I multiplied by 85. So ultimately, if I multiply this by 85, I'll be getting 20 lakh 49,279. Okay, 20 lakh 49,279. And just check what is the NPV here. It is also the same, which is 20 lakh 48,000. So this slight difference is due to rounding of errors, but under both the scenarios, your NPV is going to be the same. So whether guys you use your foreign currency approach or whether you use your home currency approach, is your NPV going to be the same? Yes or no? Then the answer is yes, sir. Okay. But guys, the approaches, that is going to be different. Okay. So now under foreign currency approach, what do we do? So first of all, we calculate what is going to be your present value of cash inflows in dollars itself. Okay. And to calculate the present value of the cash inflows in dollars, we actually need the discounting factor in foreign country. Okay. So this discounting factor in the foreign country first needs to be established. So how will you establish this discounting factor in the foreign country? Then that is going to happen with the help of that cross multiplication which we did. Okay. So how do you do that? So whatever is your interest rate in India or the inflation rate in India, first take that into consideration. So 1 plus whatever is your inflation rate. So that is nothing but, I'll write down here 1 plus inflation rate in home currency. Okay. And based on that, what is the discounting factor in home currency? And here I will write down 1 plus whatever is the interest rate or inflation rate in foreign currency, and this should be how much. So this will give you the discounting factor now in your foreign currency. Okay. So we have to calculate the present value of cash inflows in dollars. For that, we need the discounting factor in foreign country. Sometimes they'll give you directly in the questions, or sometimes we need to calculate the same. Okay. And then we will be calculating what is the NPV in dollars itself. And the last and final answer will be that we will convert NPV from dollars to rupees. At what rate? Then definitely at spot rate. Okay. So these are the 4 important points in foreign currency which you have to understand. So we need present value of cash inflows in dollars, right? Then we need the discounting factor, whatever is there in the foreign country, we have to take that into consideration. We need the NPV in dollars. And then we have to convert the NPV from dollars to rupees at whatever is the spot rate. And based on that, we'll be getting the final answer. Okay. So my dear students, these are the things, these are the 2 main approaches, and under both the approaches, I hope you all have understood that your final answer of your NPV is going to be the same and your decision making is also going to be the same. But here, before starting with the questions, you'll have to also focus on something which is called as your nominal cash flows and your real cash flows. Okay. So that is something which you'll have done in your advanced capital budgeting. If you have not done that particular thing, then you can just see the video once again. But also at the same time, now very quickly, I'll just summarize what is your nominal cash flows and what are your real cash flows. Okay. So guys, whenever we are talking about nominal cash flows, okay, so nominal cash flows are always after taking into consideration the impact of inflation. And what are your real cash flows? The cash flows in real terms are without considering the impact of inflation. Okay. So you'll have to understand the basic difference between nominal cash flows and real cash flows, because that is something which they can ask in the questions, that these are the real cash flows, but for the purpose of decision making, you all need nominal cash flows. Then we have to convert the real cash flows to nominal cash flows. Okay. So basically, what are real cash flows? Now, let's say, for example, you're a CFO, okay, and you ask your sales manager to give you some data. So the sales manager is definitely going to give you some data. Now, when the sales manager will give you the data, he will estimate the sales, simply multiply that by the selling price, and then he will give you whatever is the sales, variable cost, fixed cost, etc. And he's not going to consider the impact of inflation in that, right? Now, it is the finance manager's duty that whatever data he receives from the sales manager, okay, those are in real terms. Okay, so these are the real cash flows which will be generated from the project. What the finance manager needs to do is, the finance manager needs to first consider the impact of inflation. Okay, consider the impact of inflation, add the inflation for years, and based on that, they have to first calculate what is going to be the nominal cash flows. And those nominal cash flows needs to be discounted at your nominal discounting factor, that is the cost of capital, which is including the inflation premium, and the real cash flows will be discounted at whatever is going to be your cost of capital without the inflation impact on it. Okay, so for that, even in this particular nominal cash flows and real cash flows, these are the two approaches. Your final NPV comes the same whether you use your nominal cash flows or real cash flows approaches. Okay, that is something which you can see in the advanced capital budgeting decision videos. Okay, but coming back here in nominal cash flows, we have to consider the impact of inflation. So what we need to do is, let's say year 1, year 2, year 3, let's say we have the cash inflows which are real cash inflows of 10,000, 10,000, and 10,000. Okay, now I need, these are real cash flows, now I need what is going to be the nominal cash flows. So I have to add the inflation and then calculate what is going to be the nominal cash flows. Okay, so your real cash flows are 10,000. Okay, so let's say your inflation rate is, let's say for example, 10%. So what I need to do is, whatever is the inflation rate, I have to add it. So 10%. Okay, so I can simply take 1.1, and your nominal cash flows at the end of year 1 will become how much? 11,000. Okay, now here I have to take into consideration your inflation rate for first year and second year both. Okay, so here the power of compounding will be taken into consideration. So basically, this was 1.1, which was raised to the power 1. Okay, 10% was your inflation at the end of year 1. But here we have to take 1.1 raised to the power 2. Okay, so now this will be 1.1 square, which I need to multiply it by 10,000. So this will be 12,100. Okay, or simply you can take 10,000, you can add 10%, you can again add 10% to it. So that will give you 12,100. So that is also one of the approaches which you can use it. And then this will become 1.1 raised to the power 3. So that will be 1.331, which you need to multiply by 10,000. So this will now become 13,310. Now these are your nominal cash flows which needs to be discounted at your nominal discounting factor. Now very quickly, what is nominal discounting factor? This is your cost of capital which includes your inflation premium. Okay, so that is cost of capital, and in 99% of the cases in advanced capital budgeting, I have just highlighted this part as well, that institute in one of the questions they have considered the cost of capital without the inflation premium. But in all the other cases, we have to understand that your cost of capital is after considering the impact of inflation in it. Okay, so that's why this is your nominal discounting factor, which is always after considering the impact of inflation. That's your cost of capital. And then we will be getting whatever is your present value of cash inflows. Okay, so in real cash flows, what happens is we simply take these only 10,000, 10,000, and 10,000, and we will discount it at whatever is your discounting factor at the real rate. Okay, and that will give you the present value of the cash inflows. Okay, so that is also one of the way on the basis of which calculations can be done. Okay, now my dear students, this is something which can come in the subsequent questions about nominal cash flows, annual real cash flows, but I hope you have understood this entire concept. Okay, now coming back to your uh, international financial management, where we'll be doing all your foreign investment appraisals, your decisions there. So first I'll be starting with some practical problems which are there in your study module. Okay, I hope you'll have understood this very thoroughly, whatever we have discussed along with the example. Okay, now we'll be starting with your practical problems. Okay, so first we'll be starting with your question number 5, which is also there in your study module as your practical problem. So let us first do this particular question. Okay, now see what is given to you, that ABC is considering a project in US which will involve an initial investment of $1 crore 10 lakhs. The project will have 5 years of life, and current spot exchange rate is rupees 48 per dollar, and the risk free rate in US is 8% and the same in India is 12%. So there are two interest rates which are provided to you. Cash inflow from the project are as follows, where we have year 1 to year 5, we have cash inflows available, and we are required to calculate the NPV of the project using foreign currency approach. Okay, so there is no need to calculate the forward rates. Okay, because if it would have been a home currency approach, then you have to convert everything into your home currency rates, and then we have to discount it and we have to get the present value. Okay, so here, okay, we are lucky at least from the perspective that they have told you foreign currency approach. The required rate of return on the project is 14% in India. Okay, see, it's a foreign currency approach question, but they have given you the discounting factor which is there in India. That's the domestic or your home currency discounting factor is given to you. Okay, so we need to make little bit of adjustments for the purpose of calculation of what should be the discounting factor in US. Okay, so once we have the discounting factor in US, we have to take that into consideration, and these cash inflows we have to discount it at whatever is going to be the cost of capital in US, and then we'll be getting the present value of the same. Okay, so that is something which we need to do it. Fine. So let us now start with the solution of this question. Question number 5 of our textbook, and it is there in your study module as well. So we will write down calculation of NPV using foreign currency approach. Okay, using foreign currency approach. So in this particular case, what are you going to do? We will be preparing one table here. 1, 2, 3, 4, and 5. And also at the same time, we have the cash inflows available. So what are the cash inflows? $20 lakhs. Then we have $25 lakhs. Then we have $30 lakhs. Then we have $40 lakhs. And then the last one which is available, that is nothing but $50 lakhs. Okay. Now, what are we supposed to do? All these are your cash inflows, okay, which is there in your dollars. So we need to now discount it, okay, and we'll be getting the present value of cash inflows, that is also going to be in dollars, from which I'll be subtracting whatever is going to be the present value of cash outflows. So I will be getting the NPV in dollars itself. Okay, but the discounting factor which is supposed to be used here is nothing but whatever is your cost of capital in US. So that is something which needs to be calculated. Okay, but we have learned it very easily. This is India, this is US. First, let us write down whatever are your interest rates. So in India, your interest rate is 12%, in US it's 8%. So it is 12% and in US it's 8%. Okay, so this 12%, can be written as 1.12, okay, and this can be 1.08. And then once we get the interest rates, now let's talk about the discounting factor. We have the discounting factor which is there in India. And India, the cost of capital they have told you is nothing but 14%. So this is now going to be 1.14. So what should be your discounting factor in US? So we have to just nullify the impact 1.14, which is due to the interest rate in India, which is 12%. So I'll divide that by 1.12 and I'll multiply that by 1.08. So 1.14, if I divide that by 1.12 and multiply that by 1.08, will eventually give me 1.09928. So which is nothing but 9.93%. Okay. So from this, you just need to subtract 1. So that is 0.09928. It is nothing but 9.93%. So I've got the discounting factor as 9.93%. And this will eventually help me to calculate what is going to be the present value. So 1 divided by 1.0993. So this will now give me 0.9097. Quickly, you all can just solve this. So this will be available as your 18 lakh 19,340. I hope you guys are also solving this. You can just skip this calculation part if you have already completed it, which though anyway you all be doing it, right? 22 lakh 58,253. That is 0.6848. So this will now be 27 lakh 39,019. And the last one will be 31 lakh 14,504. So this will give you 1 crore 19 lakh 99,863 US dollars, and your 1 crore 10 lakhs is something which you are investing today. So I'll just subtract this by 1 crore 10 lakhs. So then eventually you'll be getting this as 9 lakh 99,863, which is in dollars. So I just need to multiply this by the spot rate. And do we have the spot rate? Yes, which is rupees 48. So I'll simply multiply this by rupees 48 and I'll be getting this as rupees 47 lakh 99,000 4 crore 79 lakh 93,437. So this is in rupees. And is my NPV positive? Come on, yes or no? Yes, sir. So if the NPV is positive, then definitely we can make the investment in this particular project. Okay, so you can just complete this now. Okay. Now let us start with the next question. So your question number 5 is done. I want you all to come to first your question number. Let us do 7th. Okay. Chalo. Let's do this question first. XY Limited is engaged in large retail business in India and it is contemplating for expansion into a country of Africa by acquiring a group of stores having the same line of operations as that of India. The exchange rate for the currency of the proposed African country is extremely volatile and the rate of inflation is presently 40% a year, whereas inflation in India is 10% a year. Management of XY expects these rates likely to continue for the foreseeable future an estimated project cash flows in the real terms in India as well as the African country for the first 3 years of the project are as follows. So we have the expected project cash flows in real terms. Now, this is something which I'll have to understand, that we have these cash flows in real terms. In real terms means the raw data which we have got it from our sales department. Okay. So what we actually need is your nominal cash flow. So these are all in real terms. Okay. For the first 3 years of the project. And here they have told you that in year 0, the cash flow in INR is 50,000 and they have given you rupees in thousands as well. And also for year 0, cash flows in African rands is also available. So we have to make the cash outflow in India today in Indian rupee also and in African rands as well. Okay. And not only that, at the end of year 1, year 2, year 3, we will continue to make the cash outflows in Indian rupees, and in return, we'll be getting the cash inflow in African rands, that is 50,000, 70,000 and 90,000. Okay, so understand this series of cash inflows very thoroughly, boss. That what is happening is that we are investing today. Okay, so today when we are investing, 50,000 rupees is going from our pocket. Okay, 50,000 rupees is going from our pocket today in rupees. Okay, and African rands 2 lakhs is also going from our pocket today. Okay, at the end of year 1, year 2 and year 3, we are getting some African rands. Okay, that is going to be your cash inflows, and in INR we have to give some cash outflows. Okay, so we will see first what type of approach is given to in the question. XY Limited assumes the 3-year nominal cash flows will continue. Now, can you see the wordings? The 3-year nominal cash flows will continue to be earned on each year. In the year 3, nominal cash flows will continue to earn each year indefinitely, and it evaluates all the investments using nominal cash flows and the nominal discounting rate. Okay. So your concept of terminal value will be applicable, because as you all can see that XY Limited assumes the year 3 nominal cash flows will continue to be earned each year indefinitely. Can I say this is the data on the basis of which you can calculate the terminal value at the end of the 3rd year. Okay. And we are going to use nominal cash flows. Okay. So here there are real cash flows. So first of all, you have to understand, we have to get ourselves converted from the real cash flows to your nominal cash flows. Okay. And at a nominal discounting rate. The present exchange rate, that is the spot, is given to you for African rand 6 to rupee 1. Okay, so 1 rupee is equal to your African rand 6. Okay, you are required to calculate the net present value of the proposed investment considering the following. The first part is African rand cash flows are converted into rupees. Oh, if they are converted into rupees, it means which approach they are talking about? Home currency approach, and discounted at a risk adjusted rate. So all the cash flows from these projects will be discounted at a discounting factor of 20% to reflect its high risk. So they have given to you the discounting factor. So there is no need for any adjustment of the discounting factor. The discounting factor is going to be 20% only. Okay. Ignore tax and the PV factors is given to you, and this is year 1, 2 and 3. So these are the PV factors which are given to you. So we are required to calculate what is going to be your net present value. Okay. Now see how to approach this particular question. It's a very nice question. Why? Because here the concept of real cash flows to nominal cash flows is taken into consideration. Okay. Also, the series of cash flows is also very interesting. Why the series of cash flows are interesting? Because today we are investing in rupees as well as in African rands. At the end of year 1, year 2, year 3, we'll be receiving from Africa, from the investments which we have made outside India, we'll be receiving African rands, and we also end up paying something in rupees as well. Okay. So that's why we have to calculate what is going to be the net cash inflows and do the workings accordingly. And this is a home currency approach. So basically, if it's a home currency approach, the first question which we did, that was your foreign currency. Now this is the home currency approach. So in your home currency approach, what we need to do, we have to convert whatever is going to be your African rands to rupees. But for that, we need the forward rates. We need the forward rate at the end of first year, at the end of second year, and at the end of the third year. We need those forward rates. So we need those calculations. Okay, so let's now proceed further. Quest number 7. Chal. Now, we will write down here calculation of NPV using home currency approach. Okay. So in your home currency approach, first of all, what do we need? We need the forward rates. So I'll first write down forward rates. So we actually need the forward rates at the end of year 1, year 2, and year 3. Okay, so we need this forward rates. And do we have the spot rate available? Yes, sir. What's the spot rate? You all can just check. 1 rupee is equal to African Rand 6. So rupee 1 is African Rand 6. And I'm just doing it directly without applying the formula. You can apply the formula and do that accordingly. So what is your inflation rate in India? That is 10%. And here it is 40%. Okay. So this will now give you African Rand 7.6364. Okay. So this is your first quote. Okay. First year forward rate for 1 rupee African Rand 7.6364. Similarly, uh, for the second year, I will take rupee 1 is African Rand 7.6364. And again, I'll take into consideration 10% and 40%. So this will now become 7.6364 add 40%. So that is African Rand 10.6909. So for rupee 1, okay, this should be how much? So I'll just divide that by 1.1. That will give you African Rand 9.7190. Okay, so this is for your forward rate for your second year. So, and for your third year, this is African Rand 9.7190. I'll add 10% and 40% to this. So this will now become 1.1 and 9.7190 add 40%. So this will eventually give you 13.6066. So for your rupee 1, this should now be 12.3696. So this is for your year 3. Okay. So we have the 3 years rates available for year 1, year 2, and year 3. We have the 3 African rands which are available. Okay. So we have the forward rates available. So we'll be now in the comfortable situation to first convert all the foreign currency to your home currency. Okay. So ultimately we have year 1, year 2, and year 3. So I will be now taking year 1, year 2, and year 3. We have African rands, which is 50,000, 70,000, and 90,000. 50,000, 70,000, and 90,000. So we need to convert that into rupees. Okay. So how will we do that? So we will take 50,000, divide that by 7.6364. Right. So that will eventually give you rupees 650. Oh my God. See, these are your real cash flows. So the first step is, before we convert that into rupees, okay, we have to first consider the impact of inflation. Okay, and these are your cash inflows in real terms. See, they have mentioned estimated project cash flows in real terms in India as well as African country for the first 3 years is given to you. So basically, these are your cash inflows in real terms. So we need the cash inflows in nominal terms. Okay, so that's why we have to consider your nominal discounting factor, nominal cash flows, by taking into consideration the concept of inflation. So we need to add that, right? So what are we going to do? So first we will, these from real cash flows, will be converting that into your nominal cash flows. Okay. So for converting that into nominal cash flows, we actually need, what is your inflation rate? So your inflation rate in Africa is nothing but 40%. Okay. So this can be 1.4 raised to the power 1, 1.4 raised to the power 2, 1.4 raised to the power 3. Okay. So this will now be 70,000. Then this will be 1,37,200. This will be 2,46,960. Okay, so this is something which you'll have to understand. Okay, so that is 90,000 plus 40% plus 40% plus 40%. Okay, so that is going to give you 2,46,960. So basically, this we need to now convert that into the exchange rate to get what is going to be your cash flows in rupees, which then uh, we have to discount it and bring it to the present value terms, but we have to also adjust these cash flows in INR as well, which we are actually going to pay. Okay, so we'll discuss that, but first let us convert this. So we have the exchange rate of 7.6364, 9.7190, and 12.63696. Okay, so 70,000, I need to divide that by 7.6364. So this will now give me 9167. Then 1,37,200, I need to divide it by 9.7190. So this will now be 14,117. And then 2,46,960, I need to divide it by 12.3696. So that will eventually give me 19,965. So these are your cash inflows, which are going to be in rupees. Just do the calculations and check whether you are getting this as answers or not. Now, after this, what we need to do is, these are going to be your cash inflows, correct? Now let us check what are going to be your cash outflows. So that also in year 1, year 2, and year 3, there are certain cash outflows which are given to you in your rupees. Okay, so that is nothing but 1,500, 2,000, and 2,500. 1,500, 2,000, and 2,500. But guys, here also we have to take into consideration whatever is going to be your inflation. And here the inflation rate is nothing but 10%. Okay, so 1.1, 1.1 raised to the power 2, and 1.1 raised to the power 3. So this will give your nominal cash flows. Okay, so this is now going to be 1650, 2420, 3327. Okay, and these nominal cash flows are in your rupees. So ultimately, can I say that I have these as my cash inflows and these are my cash outflows? So can I calculate for year 1, 2, and 3 what is going to be my cash inflows net? Okay, so that is now going to be 9167. From that, I will subtract 1650. Okay, so that will now give you 7517, 10, 14117 minus 2420. So that will now give you 11,697 and 19,965. From this, I need to subtract 3327. So that will give you 16,638. So these are your series of net cash inflows which you should be receiving it. Okay, and these are your nominal cash inflows, and this is something which we need to discount it at what percentage rate? So that is going to be at 20%. So we'll be getting the present value. Okay, and the rates are given to you as 0.833, then 0.694, and then there is 0.579. But if you want, you can calculate the terminal value year itself and then add it at the end of the third year. Okay, or else you can calculate it separately as well. Okay, so if you want, you can calculate the terminal value at end of year 3. Okay, and because the cash flows are constant till perpetuity, what we need to do is we can simply take 16,638 and just capitalize that by 20%. That will now give you 83,190. So if you want, you can add it here, 83,190. So this will now give you 99,828. So with the help of this, you can definitely calculate what is going to be the present value. So 7517 into 0.833, then 11697 into 0.694, and then 99,828 into 0.579. This will eventually give you 72,180. So this is now going to be your present value in your rupees. And from this, now don't forget, this is your PV of CI, 72,180. 72,180. Okay. Now we need your PV of CO. So for your PV of CO in rupees, do you have your PV of CO? Yes, sir. That is 50,000. That is for sure. So in India, it is 50,000. Okay. And of course, it's at year 0. So don't add up adding inflation to it, thinking that this is the real cash flow. So you should not add it up. Okay. So that's just going to be 50,000. And for your African rands, it's 2 lakhs. So we need to now simply take 2 lakhs African rands and divide that by the spot rate. So what's your spot rate? Your spot rate is 6. So this will now give you rupees 2 lakh divided by 6. So that will be 33,333. So this eventually will give you 83,333. And hence your NPV is going to be negative. So 72,180 minus 83,333. So that will now give you negative 11,153. And that is your rupees in thousands. Okay. So this is in negative. So what's your conclusion? That we are not going to make investments here. Okay. So these are the two cash outflows. So which we have converted that into rupees. And that's how under their home currency approach, you can do this particular calculation. Now, we will start with the next question and come to your question number 9. Okay. So this is also your practice problems, which is there, your TYK question. Okay. Question number 9. See what is given to you, that XYZ, a company based in India. Okay. Manufactures very high quality modern furniture and sells to a small number of retail outlets in India and Nepal. And it is facing tough competition. Recent studies on marketability of the products have clearly indicated that the customer is now more interested in variety and choice rather than the exclusivity and the exceptional quality. Since the cost of quality wood in India is very high, the company is reviewing the proposal for import of woods in bulk from Nepalese supplier. The estimate of net Indian rupee and Nepalese currency cash flows in the nominal terms for this proposal is shown below. So now we are very lucky. Why? Because the cash flows in nominal terms is given to you. So the impact of inflation in this cash flow is already taken into consideration, right? In the previous question, those were real cash flows. So we had to take into consideration the nominal cash flows. But here in this particular question, we have the nominal cash flows. Okay. So we have net cash flows in millions. We have as year 1, year 2, year 3. And this is nothing but your, this is 25 million. Okay. So this is 25 million, which is Nepalese currency, which we are going to make the investments today. And these are going to be your cash inflows. Okay. So in India, there is no investment required right now. We just have to make the investments in Nepalese currency. Okay. The following information is relevant where XYZ evaluates all the investments by using a discounting rate of 9% per annum, and all the Nepalese customers are invoiced in Nepalese currency. So obviously there is a concept of foreign currency here. And Nepalese currency cash flows are converted to Indian rupees at forward rates and discounted at Indian rates. So now it becomes very easy for you to calculate that this is now going to be your home currency approach. So for your home currency approach, what we need to do is we have to simply take into consideration what is going to be the forward rates, right? At the end of year 1, year 2, year 3. So we have to calculate the forward rates, and then what we need to do is once we have calculated the forward rates, we have to convert, from your whatever is your currencies, we have to convert, multiply that by the forward rate and get all these particular forward currencies, and then we have to discount it at whatever is your discounting factor in India. And based on that, we are going to calculate the present value. Okay. Inflation rates in Nepal and in India are expected to be 9% and 8% per annum respectively. And the current exchange rate is rupee 1 is equal to Nepalese currency 1.6. Assuming that you are the finance manager of XYZ, calculate the net present value and the modified internal rate of return of the proposal. And these are some factors, discounting factors, which are given to you for the purpose of calculation. Okay, chalo, great. So first of all, what is happening in this question? XYZ is actually a company. Where is it based? It's based in India. Okay. And it now wants to import woods from Nepalese supplier. Okay. So for that, it wants to make some investments there. There is some PV of CO of 25 million. But we are concerned with, because we are exporting goods to both the customers, to Nepalese customer also and to your Indian customers also. So when you are invoicing to Nepalese customers, it is in Nepali currency. Okay, so that's why we need to convert that into your rupees. We need to convert that into your rupees. Now that is very important. Okay. And already we have Indian rupees available, and all these are your nominal cash flows. So there is no need for impact of any inflation in it. Okay. So discounting rate, they have told you that is 9%. And based on all these things, now we are required to do the calculation. So the first step under the home currency approach is what? That we need to convert from your future value, from whatever is your Nepalese currency to your rupees. So for that, we need the forward rates. Okay. So let us start with that. So you all can just pause the video for the timing if you all want, and you all can calculate the forward rates on your own. That will help to build up your confidence. Question number 9. Okay. Or else you all can mute me as well. Okay. While calculating the forward rates. So this is now going to be your calculation of NPV. Calculation of NPV under which approach? Home currency. Okay. And how are you going to do this? So the first step is we are required to calculate what is going to be your forward rates. Okay. So we need to calculate the forward rates. So we have spot. What is the spot which is available? The spot is 1 rupee is equal to Nepalese currency 1.6. So rupee 1 is Nepalese currency 1.6. So what is going to be your 1 year forward? So do we have the inflation rates? Yes. And that is in Nepal, it is 9%. Okay. And in Nepal, it is 9%. And in India, it is 8%. Okay. So this will now become 1.08 is equal to 1.6 plus 9%. That is Nepalese currency 1.744. So for rupee 1, this will now be 1.6148. Okay. For a 2-year forward, now this will be again 1 rupee is equal to 1.6148. So to this, I need to add 8% and 9%. So 1.08 will now become Nepalese currency 1.7601. So rupee 1 will be 1.6297. So I can just put it 1.630. Okay. And for your 3-year forward, this will now be rupee 1 is Nepalese currency 1.630. To this, I will add 8% and 9%. So this will now become rupee 1.08 is equal to 1.630 add 9%. That is 1.7767. So for rupee 1 should be Nepalese currency 1.6451. Okay. So we have here 1, 2, 3. And we definitely have your Nepalese currency which is available. Okay. So we have cash inflow in your Nepalese currency which is nothing but 2.600, 3.800 and 4.100. Okay. And is there any concept of terminal value here? Then they have not specified it, right? They have not mentioned that at the end of the 3rd year, the cash flows are going to be constant or something like that. It's not specified. Okay. So these are your Nepalese currency. And then we also have the exchange rates which are available. So what are the exchange rates? For 3rd year, it is 1.6451. For 2nd year, it is 1.630. And for your 1st year, it is 1.6148. So this will now help you to calculate in rupees. So 2.6, I need to divide it by 1.6148. So this will now give me 1.61. Then 3 point, have they taken up to 4 decimals? Yes. So I will take same 2.6 divided by 1.6148. So that will give you 1.6101. Then 3.8, I need to divide it by 1.630. So that will now give me 2.3313. And 4.1, I need to divide it by 1.6451. So that will now be 2.4922. Okay. Now, once I've got this rupees, what I need to do next? There is some Indian rupee also which you all are earning, right? from your Indian customers. So let us take that also into consideration. So we will add now inflow from India. So what is the inflow from India? 2.869. Then what do we have next? 4.200. And then the next one is 4.600. Okay, so this is something which we are going to discount it now. At what percentage rate? So do I have the discounting factor? Yes, 9%. Okay, because they have told you that the discounting factor is 9%. And we have 9% PV factors also given to you. Okay, so your discounting factor is 9% and the PV factors are 0.917, 0.842, and then it is I think it's not printed properly, 1 divided by 1.09, 917,842, and this is 0.772. 0.772. So this will help me to calculate the present value. Okay. So let's take together 1.6101. To this you will add 2.869. Okay. And multiply that by 0.917. So this is coming as 4.1073. 2.3313. To this I need to add 4.2 and multiply that by 0.842. So this will now give me 5.4993. Then I have 2.4922. This I'm going to add 4.6 and multiply that by 0.772. This will now give me 5.4752. So the total comes as 15.0819 rupees. And all this is in millions. Okay. And this is the PV of CI, right? There is no working capital, etc. in the question. And I also have the PV of CO which is available, right? So what is the PV of CO? It is 25. Okay. So PV of CI is rupees 15.0819. From this, now let me subtract PV of CO, but that is also in your Nepalese currency, that is 25. So I need to divide that by the spot, and the spot rate is 1.6. So I will now take 25 and divide that by 1.6. So that will give me 15.625. So is this coming in negative? So that is 0.54. Negative 0.5431. This is rupees in million. Okay. Negative 0.5431. I hope you all have got the same calculations. And if it is negative, then what is going to be your view? Are we going to accept or we are going to reject? Then definitely we are going to reject this particular project because the NPV is into negative. Okay. So that is something which is there in the first part of the question. The second part of the question that actually deals with your modified internal rate of return, right? So we are also required to calculate MIRR. So let us now calculate in the second part, calculation of MIRR. Now I hope you all know what is modified internal rate of return, right? It is obviously an extended version of your IRR, but in your modified internal rate of return, we always make the reinvestments at whatever is going to be the discounting factor or the cost of capital. So at that particular case, we'll be considering that as the reinvestment rate. Then eventually we'll be calculating the terminal value, which we have to bring it at your PV of CO. So at what particular rate that PV of CI will become equal to your PV of CO. So that is something which we need to calculate it, because IRR basics purpose is what? That your PV of CI should be equal to your PV of CO. Okay. So in modified internal rate of return, if you all can recollect, we have done this earlier at inter CA level as well, where we have to take year 1, 2 and 3. So we will write down the series of the cash inflows which is getting generated. So for the first case, it is 1.6101 to this. If I add 2.869, so that will now give me 4.4791. For the second case, it is 2.3313. To this, I need to add 4.2. So that will give you 6.5313. And then I have the next thing, which is 2.4922. To this, I will add my 4.6. So this will eventually give me 7.0922. So we have to take into consideration your reinvestment rate, which is nothing but at the rate of 9%. Okay. Now, what is going to be your terminal value calculation? See, apparently, if 1 rupee is reinvested for the period of subsequent 2 years, then how much is going to be the future value? That is something which we have to understand. See, it's a very simple concept. At the end of year 1, we are getting the cash inflows of 4.4791. Okay. Now that needs to be reinvested for the subsequent 2 years. Okay. So basically, whatever is the cash inflows which you receive at the end of year 1, we need to reinvest it for the remaining life. And that's how MIRR will be calculated. So at the end of year 1, we are receiving 4.4791. That needs to be reinvested for 2 years. Similarly, at the end of second year, you are receiving 6.5313. That needs to be reinvested for 1 year. And at the end of third year, whatever you are receiving 7.0922, that cannot be reinvested. So that is going to be the same figure. Okay. So this 1 rupee will be the same. Then this will now become 1.09. And 1.09, you add 9% to it. So this will now become 1.18. Okay. 1.1881. So which is something which they have specified here also. Okay. So we have this as your reinvestment factors. Now we are in a very comfortable situation to calculate what should be the terminal value. So how will we do that? We will take 4.4791 and multiply that by 1.1881. So this will now give you 5.3216. Then 6.5313, multiply that by 1.09. So that will give you 7.1191. And this will be as it is, 7.0922. Okay. So this is 7.09. That is coming as 19.5329. So this is the terminal value at the end of which year? So this is the terminal value at the end of your third year. Okay. So what happens at MIRR? Your PV of CI should be equal to your PV of CO. So you have your PV of CO, which is nothing but 15.625. Okay. So now you can also calculate this by using amount is equal to principal into 1 plus I raised to the power n, where your amount becomes terminal value, which is 19.5329. Your principal is nothing but 15.625 into 1 plus rate raised to the power 3. Okay. So if I divide this by 15.625, I'll be getting 1.25. This is 1 plus I raised to the power 3. So now we have to use the concept of dirty power to calculate what should be the factor. So how will you do this? So now you can take 1.25 and you can square root it for 12 times or else 10 times, whatever you'll have learned. I'm doing it on the base of 12 times. This will now become 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And then what we need to do is take this for 12 times. Okay. Subtract 1 from it. Okay. Then we need the third root, so we'll divide that by 3. We'll be adding once again plus 1, and then we'll be squaring it for 12 times. So into is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So that will eventually give you 1.0772 is equal to 1 plus I. So your I will now become 0.0772, or we can say 7.72%. So this is your MIRR. So how we can do this? So you can take your root for 12 times. So 1.25, you can take the root for 12 times. Then you can subtract 1, divide by 3 because we want third root. Then you have to add 1 and then multiply is equal to 4. Once again, it's going to be for 12 times, and that will eventually give you what is going to be your final answer. That is 1.0772, and that's nothing but 7.72 percentage. Okay. So this concept is your modified IRR. I hope you all have understood this part. Okay. So with this, now your question number 9, that also gets completed. Okay. So now let's continue further. So let's solve this question number 10 first. Okay. So see what is given to you, that a multinational company is planning to set up a subsidiary company in India where hitherto it was exporting, and in view of the growing demand for its product and competition from the other MNCs, the initial project cost consisting of plant and machinery including installation is estimated to be $500 million. The net working capital requirements are estimated at $50 million, and the company follows straight line method of depreciation, and presently the company is exporting 2 million units every year at a unit price of $80. Its variable cost per unit is $40, and the CFO has estimated the following operating cost and other data in respect of the proposed project. So we have the variable operating cost, which will be nothing but $20 per unit of production. We have additional cash fixed cost, that is nothing but $30 million per annum, and the project share of the allocated fixed cost, that is nothing but $3 million per annum based on the principle of ability to share. The production capacity of the proposed project in India will be 5 million units. An expected useful life of the proposed plant is 5 years with no salvage value. Existing working capital investment for production and sale of 2 million units through export was $15 million. An export of the product in the coming year will decrease to 1.5 million units in case the company does not open the subsidiary company in India. And in view of the presence of the competing MNCs that are in the process of setting up their subsidiaries in India, applicable tax rate is 35%, and the required rate of return for such project is 12%. Assuming that there will be no variation in the exchange rate of two currencies and all the profits will be repatriated, as there will be no withholding tax, estimate the NPV of the proposed project in India, and the present value factors are given to you. Okay. You just don't have to worry about anything. Okay. We have read the entire question and I'm very sure I have not understood anything about it. Okay. But now let us quickly discuss what is the basic objective of this particular question. I'm very sure you will understand this very thoroughly. Okay. So just listen. It's a very easy question. There is a multinational company. Okay. And it wants to set up a subsidiary in India. Okay. So let's say, for example, a company which is there in US and it wants to set up a subsidiary in India. Okay. Now, the initial project cost, okay, is estimated to be US dollar 500 million. So 500 million, that is nothing but your PV of CO. Okay. The net working capital requirement is $50 million. Okay. But there is a twist which is given here. What is happening presently is that there is an MNC which is actually exporting goods to India. Okay. So presently the business operations are such that there is a multinational company, and where is it placed? It is placed in US. Okay. And what is this company doing? Presently just exporting. Where is it exporting? It is exporting in India. Okay. It's exporting in India. Now, what is happening is that when this multinational company is exporting in India, it is only able to export 2 million units, okay, where the selling price is $80 and variable cost is $40. So they are selling it at $80 and variable cost is $40. Okay. But it is now very much important to have a business place in India. Okay. At present, what is happening is they are just exporting their goods to India. And they are saying like this, that if we keep on exporting the goods to India, then this 2 million units will ultimately become 1.5 million units. So ultimately, you know what will happen? That you will end up just selling 1.5 million units. Okay. So that 2 million units will come down to 1.5 million units. So if you're just exporting, then the sales will fall to 1.5 million units. Okay. But now they are planning that let us set up a place of business in India. Let us set up a subsidiary in India and let this subsidiary only sell the goods. Now, when they are going to set up the subsidiary in India, definitely they are going to make investments in India. So they are spending some dollar, how much? 500 million. Okay. And also there is some working capital, which is $50 million. Okay. Which is required. But you know, the best part is if you set up a subsidiary in India and if you want to sell goods, then your sales can be 5 million units. So are you seeing the increase in sales? Instead of 1.5 million units, now your sales is going to be 5 million units. And also at the same time, you will be able to sell these particular goods on the basis of the data which they have told you, where it is mentioned that the variable operating cost is going to be $20 per unit. Additional fixed cost is US $30 million. The production capacity is 5 million. Expected useful life is 5 years. This can help you actually to calculate the depreciation. Existing working capital for production sale of 2 million units is US $15 million. You know what does it mean? It means that you already have US $15 million in the form of working capital. Okay. So you are in US and what are you doing? You are exporting goods to India. You are in US, you are exporting goods to India and you already have a working capital of 15 million with you. But now you don't want to export into India, you want to set up your own subsidiary in India. Then don't you think that working capital of 15 million can actually be used when we are setting up the subsidiary in India? Come on, yes or no? Of course, yes. So in India, when $50 million is required by the way of working capital, we already have 15 million in the form of working capital. So 50 million minus 15 million, can I say we just have to spend additional $35 million? Come on, yes or no? Then the answer is yes, we just have to spend $35 million. I hope you guys are trying to understand. We just have to spend $35 million in the form of working capital. No doubt we require 50 million, but our existing operations also has 15 million of working capital. So when I'll be setting up my own subsidiary in India, then I can use that 15 million and eventually 35 million is something extra which will go from my pocket. Okay. So this is a catch in this particular question. We have to remember that working capital invested at year 0 when we are setting up the machinery, that is nothing but $35 million. Okay. Continuing further, the export, as we discussed, of the product in the coming year will decrease to 1.5 million units if the company does not open the subsidiary. So that is also one type of a fear. So that's why we decide, let us set up our own subsidiary. Okay. The tax rate is also given to you, etc. So now how should you approach the question? Very easily, what we will do is, we will first calculate what is going to be the cash inflows generated if we keep on exporting. What is the cash inflows generated if we have our own subsidiary in India? On the basis of this, can we get the incremental cash inflows? Come on, yes or no? Of course, yes, we can get the incremental cash inflows. And that is something which will convert it into the present value to check whether we should make investments or not. Okay. So very simple. What we need to do, we will use the concept of incremental cash flows here. So first, if we just export, we will see what is going to be the series of cash flows. If we have our own subsidiary, we'll see what is the series of cash flows. So we can come to know what is the incremental part. Okay. Chalo. So let's start with the solution of this question. This is my question number 10. Also your TYK question. Okay. Practical problems. So what's your decision making? Your decision making is, if we set up a subsidiary in India. Okay. So first, let us calculate the cash flows if there is export. Okay. We will see what is the cash flows if we export the goods. So we'll be having the sales. From this, we'll be subtracting the variable cost. So we'll be getting your net profit before tax only. Okay. Then from this, I'll be subtracting tax because there's no other data which is given to you. We are just buying the goods and we are exporting it. So that's why we just have to take into consideration your normal income statement. No impact of depreciation, etc. will come. Why? Because we are not purchasing any machine, etc. there, right? We are just, simply taking into consideration what is going to be your goods bought and goods sold. Okay. And the tax rate is 35%. So this will give you your NPAT. Okay. And which is also your cash flows after tax. Okay. So what's your sales going to be? So now we are going to sell 1.5 million units, boss. If we don't set up our own subsidiary, we are going to sell 1.5 million units. And what's the selling price of the same? The selling price is nothing but, you all can just check. The selling price per unit is rupees 80. Okay. And 1.5 million units, which we need to multiply by the variable cost. And that is nothing but rupees 40. So this is 120. And this will be, sorry, this is dollars, right? Dollar 120 million and dollar 1.5 into 40. So that is dollar 60 million. Okay. So this will now give you dollar 60 million, which I need to multiply by 35%. Dollar 21 million, which I'll subtract. So that will be dollar 39 million. Okay. So if we export, then this is going to be dollar 39 million. What's the second part? Cash flow if we don't export, but what are we going to do next? Then in this particular case, we will be having our own subsidiary. Okay. Cash flow if own subsidiary. Okay. Now in this particular case, again, there will be sales less variable cost. Okay. And then we'll be getting contribution. Don't forget there is fixed cost. So we'll be getting your net profit before depreciation and tax. From this, I can subtract my depreciation. So I'll be getting my net profit before tax. From this, I will subtract my tax at the rate of 35%. So then eventually I'll be getting my net profits after tax. To this, I will add the depreciation to eventually get something which is called as my cash inflows. Okay. So what is the sales? So for that, I have 5 million units and the selling price per unit is 80. 5 million into 80. So this will be $400 million. Okay. What about your variable cost? Your variable cost is $40. So 5 million into 40. So that will be $200 million. So this will give you $200 million. Now let's talk about the fixed cost. Guys, for fixed cost, now you have to be very careful here because they have specifically told you that the additional cash fixed cost is going to be $30 million. Okay. And the project share of allocated fixed cost will be $3 million. Now see, allocation of expenses is not going to have any impact. Always remember this. Allocation of fixed cost, is it going to have any impact? Then the answer is absolutely no. Okay. Why? Because allocation is mere distribution of expenses. It is not going to have any further impact. So that is why, my dear students, whenever we are talking about allocated fixed cost, we always ignore it because it's simply distribution of expenses. It does not result in any additional cash outflow. Okay. So in the fixed cost, what is going to come is only $30 million. So this will be $170 million. And now let's talk about the depreciation. So for depreciation, they have told you that the plant and machinery will be your $500 million and the life of the project is going to be how many number of years? For 5 years. Okay, and there is no salvage. So definitely this will now be 500 minus 0 upon 5, $100. So this will now be $70 and we need to take 70 ka 35%. So that will be 24.5. Depreciation is 100 and this is 170, right? Acha, variable cost is 40 only, na? Oh, variable cost is now getting changed to 20. Sorry. So this is now going to be 20. Okay. So this will now be 100, 300. Okay. So this will now be 270, 100, 170. So 170 ka 35%. Right. So I'll take 170 and multiply that by 35%. So that will be 59.5. So this will now be 110.5. To this, I will add the depreciation of 100. So this will now give me $210.5 million. So what is your incremental cash inflow? So that is going to be $210.5 million. From that, I need to subtract what I was earning earlier. So $39 million. So now that will give me $171.5 million. Okay, so this is something extra which I'm going to earn. Now this is per annum. Okay, I need to multiply that by the annuity factor at the rate of 12% for 5 years. Okay, so I will simply take into consideration 0.8929 plus 0.7972. For third year, it's not correct. So let me just do it 1 divided by 1.12. 1, 2, 3, 4, 5. This is coming as PVF is coming as 3.6048. Okay. So 3.6048. Okay. So I'll multiply that by 171. 171.5. Multiply that by 3.60. That will eventually give you $618.22 million. Okay. So this is something which you are going to generate from the particular project alone. But don't worry, we also have to add the present value of salvage. So how will you add the present value of salvage? So to add the present value of salvage, what we need to do is we have to take the salvage value, which is nothing but 50, but don't worry, here we have to, there is no salvage, but there is recovery of working capital. So for present value of recovery of working capital, what we need to do is we have $50 million, from which we need to subtract $15 million which we had. So there is $35 million which I need to multiply by the PV factor. So what's the PV factor at the end of the fifth year? So that is 0.5674. So 0.5674. So that is $19.859 million. So eventually, guys, I have the two types of the cash inflow from projects and also my recovery of working capital. So this will now give me the total PV of CI, which is going to be 618.22. So that will give you $638.08 million. From this, I will subtract my PV of CO, and there are two types of PV of COs in this. First is your initial investment, and second is your investment in working capital. So that is $550 million. So this will now eventually give you uh, 535 million. 103.08 million. So that's your NPV. And if your NPV is positive, then we should accept it. Okay. So this is what is there in your question number 10. I hope you'll have understood this. NPV is positive, we have to accept it. So your incremental cash flows, that is something which you have to remember, that if I was exporting, then this was my cash inflow. If I'm having my own subsidiary, then this is my cash inflow. I have to check how much extra I'm earning. And from that, I will subtract my PV of CO. And while calculating PV of CO, we have to be very careful in understanding that what is going to be my initial investment and investment in working capital. So we took that into consideration. And my investment in working capital, remember that I already had 15 million. So something extra that needs to be taken into consideration. Okay. So NPV is positive. We have to accept this. Right. Now with this, my dear students, we are done with your question number 10th. Okay. And there is one question which is there in your TYK, the last one. So we'll do this as well. So all your practical problems gets completed then. Okay. Question number 8. So let's discuss what is this. A US based company is planning to set up a software development unit in India. Software developed at the Indian unit will be bought back by the US parent at a transfer price of $10 million, and the unit will remain in existence in India for 1 year, and the software is expected to get developed within this particular time frame. The US based company will be subject to a tax rate of 30% and the withholding tax of 10% in India, and will not be eligible for any tax credit in US. And the software which is developed will be sold in the US market for $12 million. And other estimates are as follows, in which there is rent for fully furnished unit with the necessary hardware in India, that is rupees 15 lakhs. Manpower cost, 80 software professionals will be working 10 hours each day, and it is rupees 400 man hour. And also at the same time, we have administrative and other cost, which is 12 lakhs. And advise the US company on the financial viability of the project, and the rupee dollar quote is given to you. Now see, what is this question all about? See, there is actually a US based company, and they want to sell a software to someone for $12 million. Okay, so they want to sell this software to someone for $12 million. So let's say, for example, you are a CFO of Microsoft US, okay, and you want to sell a software to someone for $12 million. Okay, so that is the price at which you want to sell the software. But now you have to manufacture the software also, you have to make the software also, you have to program the software also. So for that, what you're doing is you are approaching India. And in India, the rentals, administrative cost, the skill set is much more cheaper. So you're like, I'm going to manufacture it here so that the cost, etc., gets reduced. Now, Indian government is very smart. They are like, listen, you are setting up a unit in India, making the software here, and then you're going back to US and selling it. So in that particular case, sorry, sir, we will not allow you to sell this particular software outside India without paying tax to us. So in this particular case, there is some transfer pricing regulations which are applicable. And what the income tax department is telling is that we will consider an arm's length price. If such software is sold, then it is sold for $10 million. So we will consider this $10 million as the selling price. From that $10 million, whatever cost which you have incurred in India, we'll be subtracting that. We'll be getting the profits. On that profits, we'll charge tax. Then there will be some withholding tax. And then you can take this particular profits to your particular country. Okay. So basically, our entire objective is you have to think from the US company's perspective and see whether you should make the software in India or not. So for that, what should be your thought process? See, your thought process should be like this. Okay, let's say, for example, if I want to sell a particular software in US to a particular customer for $12 million, and let's say, for example, my cost of developing the software in US is $11 million. So ultimately, $1 million is the profit, right? Or on the contrary, if suppose you set up a business unit in India, let the government apply transfer pricing regulations, let there be arm's length price, you pay the taxes, you pay all the types of cost, but suppose that total cost still comes as US dollar 8 million, then don't you think that you will set up this particular subsidiary in India? Why? Because your selling price is $12 million and your cost, including taxes, etc., whatever you're paying in India, that's just coming as $8 million. So definitely your $4 million is going to be your profits, right? So here also the same concept will be applicable, where if you read the question, the software developed at the Indian unit will be bought back by the US parent at a transfer price of US dollar 10 million. So that is something which is prefixed now. Okay, it's US dollar 10 million. And they have told you that in India, if you are manufacturing, then what is the rent which is applicable? That is rupees 15 lakhs. There is manpower cost and there is administrative cost, and they have simply given to you $1 quote, which is $48. So just imagine a situation if, okay, this is now your solution to question number 8. Now think of a situation where you are in US, okay, and you are actually, uh, setting up a unit in India, okay. So when you're setting up a unit in India, okay, definitely there will be some cost which will be attached. So what are the types of the cost? Okay. So the first type of the cost which you have is rent, which is rupees 15 lakhs. Okay. Then we have the next type of the cost, which is nothing but manpower cost. So your manpower cost will be 80 software professionals working for 10 hours a day at rupees 400 per man hour and multiply that by 365. Okay, so that comes as 1 crore, sorry, 11 lakh 6, 1 crore 16 lakh, 11 crore 68 lakhs. Okay, 11 crore 68 lakhs. So how did this come? By taking into consideration your 80 software professionals, multiplied that by 10 hours, multiply that by 400, correct? And multiply that by 365. So that will be 11 crore 68 lakhs. And then administrative and other cost. Administrative and other cost. Okay. How much is the administrative and other cost? It is 12 lakhs. Okay. So don't be fascinated by the fact that the software engineers are getting paid 11 crore 68 lakhs. Okay. Because this 11 crore 68 lakhs needs to be divided by 80. Okay. So unka annual CTC is coming as 14 lakh 60,000 only. Okay. So this is something which you will already reach in 2 years, 3 years. Okay. So you're into a good profession, into chartered accountancy. Fine. So we have got these as your cost. Okay. Now, what is your sales? See, because government is going to charge you some tax. So what is going to be your sales? Okay. So your sales is now going to be US dollar 10 million. Okay. And the spot rate is 48. So dollar 10 million into rupees 48. Okay. Into 48. So that is going to be 48 crores. Okay. So what is going to be your NPBT? So your NPBT is coming as 36 crore and 5 lakhs. And from that, what are you going to subtract? You are going to subtract the corporate tax rate of 30%. So less tax at the rate of 30%. So that is 10 lakh 81,000, 10 lakh, 10 crore 81 lakh and 50,000. So this will give you 25 crores 23 lakh 50,000. And there is a withholding tax. So withholding tax is at the rate of 10%. So that is 2 crore 52 lakh 35,000. Okay. So this is withholding tax. So can I put it like this? That eventually what is going to happen is that this US company will sell the software, for $12 million, right? We'll sell the software for $12 million. Okay. So let us keep it in, if you want, you can convert that into rupees also, or else you can keep it in dollars as well. It's absolutely fine. Okay. So let's say we keep it in your this dollar. Chalo, dollar 12 million you are selling it. We'll multiply that by 48 rupees. So 12 million. Okay. So that is coming as 57 crore 60 lakhs. Okay. From this, now I'll subtract all the types of costs. So what are the costs here? Can I say, first of all, these are the three types of cost which the US company is going to bear. The tax is something which the US company is going to bear. The withholding tax is something which the US company is going to bear. See, because all these types are the cost. So if this US company is setting up a particular unit in India, so these are the total cost. These are the two types of the taxes which it has to pay. So ultimately from this revenue, we'll subtract these types of cost, right? So whatever are your rent, etc., then whatever is your tax and whatever is your withholding tax. Okay. So ultimately, all these three types are the cost for this particular US company, right? So we will just subtract these three types of cost. So what's your rent? Okay. Your rent is 15 lakhs plus 11 crore 68 lakhs, right? Plus 12 lakhs plus 10 crore 81 lakh 50,000 plus 2 crore 52 lakh 35,000. So this eventually gives you 25 crore 28 lakh 85,000. Okay. So eventually you will be getting in Indian rupees this much profits. or else if you want to convert that into dollars, so that will be $12 million minus whatever this cost was, 2528.85, which I need to multiply it by, I need to divide that by 48, which comes as $5.27 million. So ultimately, it's better that we calculate this in dollars only because we are calculating this from the US company perspective. So $6.73 million. So because this is positive, we would say that we should definitely set up a unit in India, let the government charge tax by taking whatever is the transfer pricing, ALP, arm's length price they have taken into consideration. And based on that, if you calculate it, then we come to know that this is the tax and this is going to be the withholding tax. And eventually, this is $6.73 million. Okay, so this is your final NPV. Okay, so the whole idea is that if I am a CFO of Microsoft and if I have got a customer where I can sell this software for $12 million, so what will I do is I will end up in India, do all the manufacturing activity in India itself, okay, and spend tax, pay on whatever is the salaries, etc., and then sum it up. So I got the total cost. See, I'm actually worried about what is going to be my outflow in India. So my outflow in India is going to be all these things, the tax which I'm going to pay to the government. So all these outflows, I'll subtract it. So eventually, my NPV, my this benefits is in positive. So I should definitely set it up. Okay. So I cannot use the word NPV. Why? Because discounting factor concept is not given to you in the question. So that's why just feasibility of the project wise, it's better that we should set it up. Okay. So with this now, all your practical problems from the study module gets completed. I hope you all have understood this part first. Okay.